This is the Commodity Show with Morgan Downey. I build Boxwood, hedge management software for companies with commodity price exposure, and I write the daily commodity news. Today, Henry Hub was an American price. With the export wave, is it becoming the world's? Global gas, LNG, and the new volatility a gas hedger has to live with Ira Joseph. This show is for educational and entertainment purposes only and is not investment, financial, or legal advice. Always do your own research. Quick one before we start. When an oil and gas trader says gas, they always mean natural gas. The stuff you put in your car? In this world that is never called gas, it is gasoline or MOGAS, short for motor gasoline. So for the next couple of minutes, and for the whole conversation with Ira, gas means natural gas. A few more words worth knowing. Henry Hub. It is a pipeline junction in Louisiana, and for decades it has been the benchmark price for natural gas in the United States. When you hear that gas was an American price, Henry Hub is what that means. Now, gas does not cost the same everywhere. Every other location in the US prices as a difference to Henry Hub, a premium or a discount for that specific spot on the map. Traders call that difference basis. Here is the big shift Ira and I get into. For most of its history, natural gas was a regional market. You could not easily ship it, so American gas, European gas, and Asian gas each had their own price. That is changing. Chill natural gas to around minus 160 Celsius, and it turns into a liquid, LNG, liquefied natural gas, and now you can load it onto a ship and send it across an ocean. And here is why anyone bothers. US gas runs about $3.50 per million BTU, the unit gas trades in, while Europe and Asia sit closer to 15. Cooling it to a liquid, the tanker across the ocean, and turning it back into gas at the far end all eat into that gap. But it is wide enough that US gas still flows out. Slowly, that is stitching these separate markets into one. One wrinkle worth knowing. For decades, that shipped LNG was not priced off gas at all. It sold as a slice of the oil price, usually Brent crude. Traders call that oil indexation. The move now is toward contracts that price off gas itself, which brings in two names you will hear a lot. TTF is the main European gas benchmark out of the Netherlands. JKM is the benchmark for LNG landing in Asia, Japan, and Korea. Watch those two against Henry Hub, and you are basically watching the whole global gas market in three numbers. One last one, NGLs, natural gas liquids, propane, butane, ethane. They come out of the same wells, but they are their own set of products with their own prices. Do not lump them in with the methane everyone just calls gas. That is your couple of minutes. Now, Ira Joseph.
Today I'm joined by Ira Joseph, one of the most experienced gas and LNG analysts anywhere. With more than 30 years in the market, he is a senior research associate at Columbia University's Center on Global Energy Policy in New York. Before that, he spent 2 decades at PIRA, PIRA, and then S&P Global Platts, where he was global head of gas and power analytics. He actually started PIRA's European gas and power and global LNG services back in 1999, before most people were even calling this a global market. And before that, he was editor-in-chief of World Gas Intelligence. Ira, welcome. Before we get into it, tell folks a bit about yourself, how you ended up in nat gas, and what you're working on at Columbia.
Thanks, Morgan, and thanks for having me. I ended up in natural gas because the world of oil was too crowded at the time I started working back in the late 1980s. So there was an opportunity to work in journalism at the time on gas, and I worked with the great Patrick Heron, who started World Gas Intelligence and then went on to start his own empire and price reporting service in Europe. And I've been working on it ever since then. For the past 3 years, I've been at Columbia University's Center on Global Energy Policy. We are where we look at the intersection of markets, policy, and technology in all forms of energy, not just natural gas. And prior to that, as you mentioned, I was at S&P Global. But I do love being at Columbia University. I do love what we call CGEP. For those of you who are unfamiliar with it, I would recommend going to the website where all of our information is free and available to anybody who wants to read it, and to please reach out to any of us, not just me, but any of the scholars in the different fields of work that we do, because we do cover everything from coal and oil all the way through wind turbines and battery chemistry. So you get the full menu of coverage on energy policy, markets, and technology at our Policy Institute. And again, Morgan, thanks for having me on. And let's talk a little bit about natural gas.
Yeah. So Ira, for most of its life, Henry Hub nat gas was a
Mhm.
domestic price. It answered American weather, American production, American supply. With the export build-out, is Henry Hub still an American price, or is it becoming the world's price?
I mean, I think it's still an American price, but what's influencing Henry Hub is definitely going to change in the years to come. Right now, if you combine both U.S. LNG exports and pipeline gas exports to Mexico, we're pushing 26% of total U.S. supply is being exported. And also, I think maybe more significantly than that, like a vast majority of the growth in demand for U.S. gas is heading towards either making more LNG or sending more gas to Mexico. So the influence of Henry Hub on the global market is clearly becoming more significant because all of this LNG, at least, is priced off of Henry Hub, and it's definitely going to increase over time as more contracts are signed, as more deals are done, as more spot deals are done. The association to Henry Hub will continue. Now, that being said, this is going to work in both directions. And when you have TTF in Europe and JKM in Asia making independent price movements, that's going to eventually also affect Henry Hub as well. And the interplay between Henry Hub and these two global benchmarks in Europe and Asia is really the future of the market. But again, the way Henry Hub influences them and the way they influence Henry Hub, we're only scratching the surface of that now. Obviously, since 2022, lost 250 billion cubic meters a year of traded gas supply in a market that had a traded gas supply of close to 950 billion cubic meters. So it's a huge chunk of what the world's gas that was trading in the world 4 years ago doesn't exist right now. So we have to wait kind of until, Qatar comes back, the expansions go on, and possibly some or more, at least, let's say, Russian pipeline gas comes back into the market. I think it will help determine sort of how Henry Hub interplays with TTF and JKM.
In terms of exports from the US, where are we in the build-out? How much capacity is real and running?
Can tell there are hiccups here and there. You get ups and downs, particularly in the second and early in the third quarter, because of a lot of planned maintenance that goes on at a lot of facilities. But, we've kind of been between like 17 and 20 billion cubic feet a day of LNG exports for the better part of the year. And that's going to ramp up. I mean, Golden Pass is really the big addition this year, but you also have Corpus Christi Train 3, I believe, and some Plaquemines capacity also ramping up as well. So it's obviously not ramping up by as much as we've lost from Qatar. So on a net basis, we've definitely lost a lot of LNG in the market this year. So LNG supply, I looked just the other day, LNG exports just globally are more or less where they were exactly a year ago. So basically losing Qatar was the same as basically losing a year of supply growth. But we're more or less back where we were a year ago. That speaks to how much new LNG supply has come into the market over the last year, that you could lose 77 billion tons of Qatari capacity, and we've basically added that much just in the last 12 months. And we were just getting started here, when we're talking about the expansions that are going to go on over the next 5 years. Now, all of that is kind of put into a state of flux because of the situation in the Middle East, because Qatar was representing a pretty hefty chunk of what that capacity expansion was going to be over the next 5 years. But we'll see. We'll see what happens.
You mentioned Qatar and the ongoing conflict in the Strait of Hormuz with Iran. And there's demand coming from the rest of the world in terms of LNG demand. But nat gas is still, this morning, it's under $3 per MMBTU. We're back in the twos. Is US nat gas destined, it's always been cheap, relatively cheap, because the US is such a massive supplier. But is it destined to stay cheap? Are we destined for ongoing growth in demand from outages in the Middle East, economic growth around the world? But supply is going to continue to grow in the US to meet that demand, and we're going to be here $3 gas for the next 10 years.
No, I mean, I think there will be some upward pressure on gas. I know Wood Mackenzie just put out a forecast earlier in the week or late last week that we're going to go towards $5 per million BTU. I think that's a bit much, frankly. But, to say that we're going to be in the $2.50, $3 range sort of indefinitely, I think we'll be a little bit higher than that. But obviously there's a lot of moving parts to what I'm saying here. So let's go through a couple of the moving parts. The U.S. in certain areas, like in the Permian Basin in West Texas or Marcellus Utica, there is some capacity constraint issues. When we're not looking at Henry Hub, well, we're looking at, let's say, a Waha price or a Transco 6 price. Those prices are going to be discounted and depressed relative to Henry Hub because there's not enough pipeline capacity to take the gas from the producing areas to either the consumption areas and or the export areas. So that's one level of price depression, somewhat indirectly tied to what you're talking about, Morgan, which is Henry Hub, which has become sort of a premium price area in the U.S. gas market, which it used to be the cheapest price in the U.S. market. But because all the gas is flowing towards the U.S. Gulf Coast, because most of the growth is coming from LNG exports, the Henry Hub price is the price to look at not just for U.S. markets, obviously, but for some global signals as well. So I see, I do see some upward creep in price over time, but not right now. I mean, the U.S. is LNG export constrained right now. If the U.S. obviously could export more LNG right now, it definitely would, given the spread between U.S. prices and prices in Europe and Asia. There's a lot of money to be made, a lot more money than anybody, I'm sure, anticipated making even before 2022, and certainly during the Qatari shutdown. You have those things that are causing this sort of bubble, not artificial, but a bubble in prices elsewhere in the world relative to the U.S. market. So export constraints is really what's depressing the U.S. market, as is the constantly changing nature of the gas to oil ratio in U.S. oil and gas production. As time goes by, as more U.S. oil and crude oil is produced, that production is becoming what they say is gassier and gassier. I don't even know if that's a word, but let's call it a word, where the amount of gas coming out of the ground relative to the amount of oil coming out of the ground is becoming higher and higher. So you have this incredibly interesting you have this interesting situation in the U.S. upstream where producers are saying much of the tier 1 acreage is gone and we're going to be moving towards lesser and lesser quality acreage for oil production. But at the same time, the amount of gas that's coming from that production is going up. So, there's a party out there of people who are saying we're going to lose gas production net over time because we're losing oil. We're going to lose oil production at some point over time because we're moving towards inferior acreage that we're producing from. And then there's a party out there that's saying gas production is going to go up, and it kind of has to go up given the amount of demand we're about to create for it in the LNG market, and it needs to go up. And therefore, if you can't produce associated gas with oil, we're going to have to produce more dry gas, and dry gas is inherently more expensive than obviously associated gas, which is produced essentially at the price of zero. And therefore, that's going to put upward pressure on prices. Somewhere, obviously, the truth exists between those two worlds. And that's going to exist between the world of $3 gas, as you say. There's $2.50 to $3 Morgan in the bearish scenario. And in the bullish scenario, we're looking more towards $4 to $5 per million BTU. That being said, though, and I know I'm rambling on a bit here, the price at which Henry Hub can go up to isn't infinite, because it has to operate and has to exist in a world where TTF prices and JKM prices exist. So if there's too much upward pressure on prices, it's going to make U.S. LNG exports uneconomic relative to JKM. And then inversely, if JKM and TTF come down too much, it's going to make Henry Hub look too expensive even at $3, and therefore we're going to have some sort of adjustment on U.S. LNG exports as well, which will immediately kick back into the Henry Hub price and weaken it as well. So there's a lot of moving parts here, and obviously with Qatar and Russia aside, when this happens and how this develops is going to be something that's not really predictable.
Yeah, and you mentioned in terms of price formation, you've got Henry Hub in the US, TTF in Europe, and JKM in Japan. How tightly are these three hubs linked now? My background is primarily on the oil side, but I'm very familiar with, as a lot of oil traders are in the nat gas market. In oil, every trader knows the ARBs. They look at the ARBs constantly. Brent TI, the Atlantic ARB is the most classic one. The product ARBs and the diffs, the jet regrade and all that kind of stuff. Do you think there'll ever be a morning where you see Dutch TTF rally by $3 per MMBTU and US Henry Hub rallies by $3 per MMBTU?
I do, but that day is not today. I mean, right now, the US is completely disconnected from the rest of the world. Now, TTF in Europe and JKM in Asia, they trade in the exact way you're talking about here. They trade relative to each other because both Europe and Asia are trying to attract LNG or not attract LNG for various reasons, and they create arbitrage windows on a relative netback basis for U.S. exports to go either to Europe or to go to Asia. In that regard, TTF and JKM are connected to each other. The U.S. at $3 per million BTU relative to to $15, $20 per million BTU volumes on the other side of the world, are not connected at all. I mean, right now it probably costs between, let's roughly say $1 to $3 per million BTU to ship LNG from the US Gulf Coast to either Northwest Europe or to Asia. So obviously, if the spread right now is over $15, that is not an efficiently operating market. And it's not efficiently operating because the US is export constrained. It only has so much LNG export capacity. If it could export more LNG, it would. And if that scenario did emerge, hub prices would go up because there would be more demand for US gas supply. And that would push up U.S. LNG exports, and that would probably also bring down JKM and TTF to some extent. But we will have convergence at some point. That's not happening today. It's not happening probably anytime soon, particularly with the Qataris out and still with the Russians largely out of the market. But at some point, the markets will move towards a situation where transport differentials between the U.S. and Northwest Europe and the U.S. and Northeast Asia will dictate the market. And so, when you look at whatever those costs are, that is sort of where the market will gravitate to. Obviously, will that mean, a differential at, between $13 and $15 per million BTU, or will that mean a differential between $3 and $5 per million BTU, or $6 and $8 million per million BTU? That's obviously for the trading community. The key question here is when the market moves towards a truly globalized structure where flows of LNG are based on transportation differentials, where will the absolute price be is still, remains to be seen. My view is that it'll probably be on the lower side going forward, but there are those who, are willing to defend higher prices and a $2 to $3 range at higher levels than maybe I would assume.
Interesting. And so we're 2026 now. Do you think by 2030, the end of the decade, you might have a little bit more connectivity? Obviously, it'll grow over time. It should grow over time. But you're saying it'll start with Asia and Europe first because they're the flexible buyers demanding.
Well, they're already connected. Asia and Europe are fully connected on price. If you look at any type of price movements between those two markets, whether it's the summer or the winter, they tend to invert in prices between those two times of the year, but they are definitely fully connected as markets. By 2030, it's really hard to say. I mean, the Qatari situation is such a big part of what we're talking about here. But let's just say the war is going to end in 2 weeks and Qatar is going to be back to full capacity by the end of the year and their expansions are going to go forward. In that case, the U.S. will grow, Qatar will grow, and the U.S. will become the world swing supplier. And when the arbitrage window is open to take LNG exports from the U.S. to elsewhere in the world, the U.S. is going to maximize LNG exports. If we have a situation where TTF and JKM come down and Henry Hub refuses to go down with them, and we do hit a situation like we did right before COVID where we had LNG shut-ins in the U.S. market, that's going to be how the market works going forward. And the market will balance on, U.S. LNG export capacity and at what utilization rate it's going to run over time. But as you said, Morgan, I don't realistically see that happening before maybe 2030 is out there a bit, but 2028 certainly at this point, because we just don't know what's going to happen with Qatar. And it's such a critical part of what we're talking about here. And then we could have a whole different discussion about what would happen in Russia in a post, Vladimir Putin era, about its relationship with Europe and how much pipeline gas Europe is willing to take or rely on going forward. I mean, prior to the Russian invasion of Ukraine, if you looked at European gas imports, from the world, they were up to around 65 or 70% of their gas imports were coming from Russia, which obviously was too large of a dependency now when we look at in retrospect. I'm assuming here that Norway is internal Europe in what I was telling you here. Right now, in June, I just looked, the U.S. is supplying 35% of European imports. It's also moving towards a dependency that I think maybe Europe and a lot of buyers are not necessarily comfortable with. Obviously, it's not the same thing. Gazprom is one supplier, whereas the U.S. has multiple LNG suppliers, but it's still from one country. And it's still coming from one country in a world where markets and geopolitics are intersecting in ways that we haven't seen before. And so the issue of dependencies and diversification and supply flexibility are becoming much bigger factors in the market than they were before. And to look at it just purely commercially in the future may not necessarily be the only way to look at the market.
You mentioned the geopolitical situation, and everyone talks about oil for obvious reasons. And but it's interesting, nat gas with the Nord Stream pipeline being knocked out, the Russia situation and the sanctions in Europe, and now Qatar. So nat gas is one of the biggest beneficiaries, U.S. nat gas, of geopolitical turmoil. It never was that way in the past. The world could be on fire and US nat gas wouldn't care. Now, if you're trading nat gas, you have to watch what's happening in Europe and the Middle East,
I
in
mean,
addition to oil.
and that's absolutely true. I mean, still though, unless something happens to U.S. LNG exports, it's not going to affect Henry Hub that much. If we had some sort of incident on the U.S. Gulf Coast where there would be some sort of disruption in exports of some kind, that would have a much more direct effect. But the Qataris being in or out of the market, or Oman or anyone else, is just a matter of how much more money LNG producers in the U.S. or Nigeria or Algeria are going to make, relative to what they were before. And right now they're making, incredible amounts of money. I mean, they're making more money in a year than I assume most of them had assumed that they were going to make in a decade. And so it's a great time to be owning, FOB, LNG, export capacity.
Yeah. And in terms of contracts and the way a lot of contracts were set, all of these new facilities, export facilities, to gradually move away from contracted supply, term supply contracts, to more of a spot pricing type situation. Is that inevitable, or do you think long-term supply contracts are going to continue as the default, with the spot being marginal?
I think both can be true. I think, long-term contracts will exist and continue to exist, but they'll be indexed to spot gas. So you can still sign a 10-year contract or 15-year contract to lift US LNG, but it will be indexed to Henry Hub. So the price of it will be moving based on what the spot market of the day is. Whereas in the more traditional way things were done, the market was still indexed to spot. It was just indexed to spot crude rather than spot gas. And then it was maybe...
And is that oil indexation dying, or is it quietly making a comeback?
It's a great question. I mean, the Qataris are not letting oil indexation go. I think it's their preferred method of sales. However, given the Qatari situation, their role as a reliable supplier of LNG to the market is going to, I think, force them to maybe offer more attractive prices for them to secure markets for their LNG. That doesn't mean they're not going to index it to Brent and they're going to start indexing it to JKM or TTF or Henry Hub. But I think they will have to offer some concessions on price in order to create more long-term LNG contracts. If, as to your point, Morgan, they want long-term LNG contracts. Right before the shutdown here, Qatar had sold none of its Golden Pass LNG out of the U.S. under long-term contract, and had sold maybe 10, 20 million tons of its 70 million ton expansion. 70 is it? Yeah, a little more than that. 75 million ton expansion from Qatar itself. So while they were the big supporters of signing long-term contracts indexed to oil, they hadn't been doing a very successful job of it recently in terms of their expansions. All of their 77 million tons that they currently produce or would be producing if the situation wasn't like it is, are under contract. But the other really interesting thing about the contract market is who is signing the contracts. And that is really a real key evolutionary point in the market, is that we've gone from a point A to point B market in LNG where LNG producers would sign contract with LNG end users or import terminals near where the gas was being regasified and then used as gas in the LNG market. Now, consistently, year after year, about half of all LNG is being signed up under contract by what we call portfolio players or traders, or basically a company that's going to have to resell the LNG to someone else in order to clear the market. And that's something, it hasn't started happening yesterday, but I would say over the past 5 to 10 years, this has been a pretty consistent pattern, is that we've gone from a market where it was very difficult to get your hands on supply to a market where it's more difficult to get your hands on demand. And what's happened is that in that market situation, a lot of the volume has moved towards what I call the middle of the market. So your majors, so your Totals, your Shells, your BPs are taking on more supply risk by loading up and creating length on supply. And then, your trading companies like Vitol or Trafigura or trying to think of a third example, but have taken on, more length as well. So the length has really moved from the upstream or the production part of the market to the middle of the market. And that's one of the fascinating things about the LNG market going forward, is we've never had this much length in the middle of the market, where over half of the contracts being signed are being signed by companies that are going to have to resell the LNG. Now, some of them have already resold the LNG and essentially done a long-term back-to-back trade, but certainly not all of that's true. And so we have so much of the market in the middle of the market right now, and we just don't know how that's going to work, but it's definitely going to be a much more liquid spot market going on in the future.
And going back to just the US, you can't read the news without seeing stories about the two demand shocks fighting the same molecule of nat gas at the moment. You've got the data centers on one side, and you've got the power burn for electricity on the other side for air conditioning demand and general electricity use. So you've got both data centers, power burn, pulling domestic gas at the same time exports are. And supply has responded well so far. Does that continue, or are we at the margin barely able to continue? And there will be a point where the US learns what Europe has seen and what other parts of the world have seen, what a tight nat gas market looks like. Because the US has kind of marginally gotten through all of this growth, this demand growth, with matching record supply growth of domestic nat gas. And without a huge major price increase over time, on average, I mean, you have occasional spikes, weather-related, but you're natural. But do you think that supply can continue to respond? Or do you think that the US has a moment where gas becomes an issue?
Look at US gas demand in general. It isn't going up. So part of this data center, I think is a bit hype, but also a bunch of it is that if it's going to happen, it hasn't even happened yet. When we look at like gas demand in the power sector in the US, while we're getting daily records in some certain months, on aggregate, we're not seeing a huge amount of gas being burned in the US power sector in terms of more than it would have been in previous years. So let's just start with that. And yes, Henry Hub prices went from, the middle twos to the middle threes between 24 and 25. And now this year, like you said, they're still around $3 per million BTU. These are not high prices. And certainly where a lot of the data centers are being built, they're being built predicated on the idea that they're going to solve a stranded gas problem, because in places like, Western Pennsylvania or West Texas, gas prices can be negative for long periods of time because there's too much gas and not enough pipeline capacity to take it away. So in that regard, the data centers, it's funny, data centers and AI started out as a way to rescue stranded gas from chronically low prices. It has evolved into a story of, as you're implying here, Morgan, oh my God, we're going to have runaway prices and we don't have enough gas to meet all this data center demand. Those are two very, very different stories. And the narrative around that has really shifted a lot, just even in the past year, where it was going to rescue gas to oh my, we're not going to have enough gas to use both for data centers and for LNG exports. Now, those are two very, very different stories. And certainly the data center demand that we're seeing is not yet there in the way that it's being hyped up to be. The gas turbines have to be ordered. The combined cycle plants behind the meter need to be deployed. The use of gas in these data centers and AI has barely even scratched the surface yet. And of course, as you know, the amount of opposition to these data centers is growing by leaps and bounds, not just from the left, but also from the right. As with anything in the U.S., things are going to take time to go forward. But longer term, I think your story is a valid one and one that needs to be looked at, which is, what is the bearable price for gas in the U.S. that will come from data centers versus what is the bearable price for U.S. gas that's going to flow into LNG exports? Who is willing to pay more for gas and who is willing to not pay more for gas going forward? Now, from my experience with data center use so far, is that they basically don't have a ceiling on price as far as I can tell. They need the 5 nines, as they say, and the ability to operate at 365, 24/7. And they're willing to pay a pretty high price for gas, probably higher than any other type of consumer in the United States, I would imagine, to keep data centers going, because in terms of their overall cost, it's not a significant cost for them. The LNG market does not have that same flexibility. At some point, if Henry Hub prices go too high relative to TTF and JKM, US LNG could get priced out of the market. And if, as I said earlier, if TTF and JKM come down because the LNG demand growth around the world isn't as robust as people assumed, and a lot of the resellers and traders we were talking about are having trouble flipping cargoes into the market, those prices could come down and then also affect Henry Hub as well. So the data center story is still yet to be written. I would caution most of the listeners here that in my experience with prior, demand bubbles or potential demand bubbles, only about, 10 to 20% of the capacity that's announced that will ever actually get built. And so the kind of numbers that you're hearing in terms of data center growth, and particularly because of its effect on gas demand, I would not get too hyped up on that, because in reality, prior iterations of this have shown that the announced number of projects relative to the projects that are eventually built is much, much smaller than one would assume.
Yeah, and I guess nat gas also doesn't operate in a vacuum in that it has to compete with other fuels, coal and renewables, solar, wind.
Yeah, I mean, I think that's an issue more for the rest of the world than the U.S. I mean, the U.S. has a lot of cheap natural gas. It's going to have a lot of cheap natural gas for, an indefinite period of time. Now, that being said, U.S. gas demand isn't really growing very much in the U.S., even at those cheap prices. Now take LNG and take gas that's coming out of the U.S. and double the price or even triple the price to take it to another market. What is the scenario in which LNG demand growth occurs at 3 times the price when it's not even growing in the market where the gas is coming from? And that, I think, to your point, Morgan, when you talk about coal and renewables, that's where I think LNG is particularly vulnerable, because in the past, and when I say the past, let's say 10 years, 15 years ago, most of the assumption is that most of the power generation going forward around the world was going to be met by incremental gas-fired power generation to that degree, and to some extension, other sources such as coal. But with the rise of, solar and wind, with the greater levels of comfort because it's less expensive because of coal, the combination of coal and renewables has been a very detrimental story for gas demand growth around the world, particularly in countries that are going to need to import LNG. Because like I said, at the end of the day, the LNG is expensive. And if there are, as you said, less expensive alternatives over time in terms of renewables, in terms of batteries, in terms of coal even, that makes it a little more difficult for LNG growth going forward. And that's something that I'm particularly worried about in the market, is that the amount of supply coming into the market, not only in the short term, but even the medium to longer term, is greatly outpacing the amount of demand growth we're going to have. And the only way that really gets solved is through price over time, which means lower LNG prices. But because LNG is expensive, both to create and to operate, even on a short-run marginal cost basis, the price of LNG can only come down so much before we have production shut-ins, as I mentioned before.
And this year we've seen Brent crude, for example, from the 50s to mid-hundreds, and back down to around the 80s today. But when people look at crude oil volatility and the refined products volatility, I always remind people to look at nat gas and then look at electricity, because you ain't seen volatility until you've seen nat gas volatility and electricity price volatility. Is US nat gas structurally more volatile now that a European cold snap is now a Henry Hub event?
US gas price volatility, it won't come from overseas, because the US market will still be constrained by the ability to export the LNG. If and when we're at a time when the US is exporting LNG that potentially is pulling up the price of Henry Hub, I don't think we're there or we're anywhere near that time yet in terms of price. I think kind of the rest of the world has to calm down before all that happens. And, now that we have, we're in a $15 to $20 range in Europe and Asia, those prices have to come down below $10 before we see that type of like tit for tat that you're talking about between Henry Hub and the rest of the world. Right now, it's just sort of open season to make as much money as you can, to export as much you can from the U.S. market. And because the price of the gas in the rest of the world bears no resemblance to the U.S. price. When we get to a world where where Henry Hub prices are within, let's say even $2 to $3 of prices in the rest of the world, I think what you're talking about will be much more relative volatility created by the global gas market within the U.S. market will eventually emerge. But we're nowhere near that right now. Right now, it's just produce as much gas as you can, produce as much LNG as you can, and export it, and cash the check.
If you're a U.S. producer today, 2026, what risk are you carrying today that you weren't 5 years ago? Would you say you need to be more hedged? A lot of producers, obviously nat gas producers, do hedge up to decent amounts of their production over the next 12 months, 24 months. Do you think as a producer today, you should be more inclined to hedge or less inclined to hedge? Do producers, I guess you're producing more, but are you producing more into a more volatile market and therefore you should kind of hedge more?
I'm inclined to say I would go to the less side. I would be inclined to say at this point, because what you have in the U.S. market is you have guaranteed gas demand growth happening over the next 1 to 2 years. With all of this new LNG capacity coming online, even 3 years, you have a huge amount of LNG. It's like guaranteed demand going forward. In most markets in the history of the gas business, you never had guaranteed gas demand. Here you have guaranteed gas demand. And I'm putting aside data centers, because let's just say data centers don't grow at all for now. But you do have this LNG export capacity that's going to come. It's going to exist. Everyone knows it's coming. And to hedge into a market where there's going to be guaranteed gas demand growth, I just seems like you're potentially giving away some potential upside. So to create, maybe assume or absorb more risk in that environment, I would argue maybe would be a good strategy for U.S. gas producers in the next few years. I'm not saying that's forever because, like I said, there's a situation here where the global LNG market becomes so glutted that global prices push back down Henry Hub prices back into the U.S. market, and we could get to a very, very low wellhead price going forward. But not right now, and not in this world. Not with one of the world's largest single LNG producers, not even producing right now, and what was formerly the largest gas producer in the world, Gazprom, not cutting exports from 170, 180 billion cubic meters down to 35 billion cubic meters. This is a world that's lost a huge amount of gas. And so given the guaranteed gas demand you're going to have from LNG export facilities going forward, I think there's an appetite out there maybe to not hedge as much because of the potential upside going forward. Now, obviously that can change a lot. And then you can throw in the data centers as well. I mean, I think that's fair. I'm a little bit more skeptical about the data centers, but if you're a big believer in gas demand growth coming from data centers, then that just throws it on top of it because you'll have guaranteed LNG demand growth, and then you'll also have guaranteed data center demand growth. I'm a little more skeptical of the latter, but the former is going to happen. The infrastructure is being built and the demand is going to come. So that's kind of the way I would look at it. Maybe consider either selling LNG off of their own account or signing gas to LNG contracts, with buyers around the world and not just focusing on the U.S. market going forward. Because as you point out, and the whole premise of this discussion that we're having is that U.S. gas producers and the U.S. gas market is going to be exposed to the global gas market. So you can't just ignore the global gas market, and you have to trade it as if it's a component or an element of the U.S. gas market, or vice versa.
And do you look at the NGLs at all, natural gas liquids like ethane, propane, butane?
No, not really.
Natural gasoline?
Not really, no.
Okay. It's interesting that they're also over time trending towards more international, propane moving to Asia, and even ethane, which usually doesn't really move outside of the US Gulf Coast. Some cargoes of that heading to China, displacing some of the naphtha markets in plastics over there. But I think whatever happens, people say globalization is over. Not in the nat gas market. It's the complete opposite. No one told nat gas.
Yeah.
Good stuff. Well, thank you very much, Ira. This has been great and very interesting to talk, especially on the globalization of the nat gas market. Where can people follow your work? What kind of do you have links and other socials? And I'll put them in the show notes also.
Well, yes, I do. I spend a considerable amount of time thinking out loud on Twitter or X. So I am on there. It's just Ira_Joseph. So I have a lot of good people I talk to, and we have, even by Twitter standards, we have really good dialogue, and we have mature dialogue when we talk about LNG and natural gas on there. So I would urge anybody who's listening to this to follow in that world. And then, of course, at Columbia as well. And again, I would urge any listeners to reach out to our different scholars, not just me, but we have over 30 scholars who work on every aspect of the energy value chain. And they're very well versed in not just markets, but also, of course, policy. We are a policy institute, and technology as well. There's a lot of smart people working at Columbia who work on all these issues, and I would urge everybody to go there. Again, it's energypolicy.columbia.edu, and that's the Center on Global Energy Policy at Columbia University.
Very good. Well, thank you very much, Ira, and I hope to have you back very soon.
Thanks, Morgan. Thanks for inviting me. And always love to talk about natural gas and LNG in the future. Take care.
That's it for this one. Thanks again to Ira Joseph. You can follow Ira on X at Ira_Joseph. And the Center on Global Energy Policy at Columbia publishes all of its research free at energypolicy.columbia.edu. If you got something out of this, follow the show wherever you listen. You can find my daily commodity news and more at boxwoodapp.com. I'm Morgan Downey. Talk to you next time.